Welcome to the Market Outlook kicking off 2026 from Principal Wealth. I'm Julina Ogilvie, partner and wealth advisor, joined by Bob Paolucci, our founder and CEO. Happy New Year.
Happy New Year, Julina.
Yes, we're hoping that everyone had a great holiday season. We're excited on what we are going to communicate today. The title is Great Expectations, and this is borrowing from the Charles Dickens novel. And I have a quote, Bob. Can I share it?
Let's hear it.
All right. It is take nothing on looks, take everything on evidence. And I think that it's pertinent to the environment that we're in regards to separating the narrative from the reality.
Absolutely. Yeah. It's about execution, not about talking. Yeah. And I think the title is fantastic because expectations are great. They're quite high. We're hearing a lot of stuff. Hopefully, we get a lot of execution of that stuff that we're hearing. And if we do, we should have a robust economy this year and potentially for years to come. And what comes along with that is usually robust capital markets.
Mhm.
So,
We'll get into that certainly in this presentation. Our agenda today is basically broken into three, but I will say this first, Bob. When we first prepared for this outlook, we started with over 150 slides, trying to decide what we should discuss for the year ahead, and we have boiled it down to three key areas. If you
yeah,
want to go through it.
yeah, it's a very good point. So, I think what a lot of people don't know is we do our own research internally. And on top of that, then we apply, opinions and articles and outlooks from, usually about 20 different firms, really to test our thinking, to see what we missed, to sort of nudge us one way versus the other.
Mhm.
If we're on the fence with some of our thinking, we dig a little deeper into some of the other good research firms out there. And, all in all, if you count the pages of paper that we go through to prepare for this, it's probably somewhere around 10 to 15,000 pages that we go through. So we take it very seriously. And I feel like if you've been with us for an extended period of time, our accuracy for predicting these things is quite high. I think the results usually speak for themselves. Hopefully, this year, we're as accurate as we've been over the past three. I got a feeling we will be, and we'll go into why shortly.
Yeah, and we'll get into that as we talk about, first the review of 2025. We are then going to go into the capital markets outlook setting up for this year. And then, as we did last year, we have several key themes that we think will drive the market this year, which we will get into in a little bit, if that's fair to
Yeah,
say.
yeah,
Okay.
we'll have fun.
Let's kick it off then first with our outlook and how we started the beginning of 2025 and what we thought were the key ingredients for that year.
Yeah, so towards the tail end of 2024, what we saw was a 10-year Treasury yield, which is usually um, the 10-year Treasury has certain levels, and it was quite high entering 2025, and we thought that it would decline throughout the year, giving room for an equity market to rise. Sometimes it caps the equity market when it's too high, and we thought, seeing that it hasn't closed above 5% for the past 15 years, that it wouldn't anytime soon. And it didn't. And actually, when it peaked out around 4.9 or so, it started to decline all the way through 2025.
Sure.
So, what we saw, Jelena, with the 10-year Treasury coming out of 2024 was that it, peaked around 4.9, close to 5%. But then all throughout 2025, it declined, and that decline allowed the stock market to breathe a little,
Mhm.
to stretch its legs. So we got that one right. We talked about the influence that policy would have in 2025. Again, this is our January last year outlook. We
Mhm.
talked about monetary policy, which is the Fed. We talked about fiscal, which was some type of government bill, and we talked about trade having an influence. And what do you know?
Wow, did it ever?
What do you know? The Fed cut three times. Tariffs arrived, um, and have since sort of cooled off quite a bit. and Congress passed the One Big Beautiful Bill Act, which is your fiscal side of it.
Mhm.
We talked about the influence of less regulation. We talked about IPOs and mergers and acquisitions rising from the dead. There was, you know, we slowed to no activity really in IPOs and M&A from let's call it 21. We started to see some start to fizzle out. There was really not much in 22, same for 23. And we had a little pickup in 24, but 25, at least halfway through the year, we started to see the influence of a lot less regulation. So it just created more M&A activity and IPOs.
Yeah.
So we got that one right. The employment picture we talked about, coming out of 13 and I'm sorry, 2023 and 2024, all we heard about was inflation. And we thought, hey, inflation is in the twos and it's probably going to stay in the twos all throughout the year.
Right.
The Fed is going to be looking at something else, their other mandate, which is employment. And what do you know? It was employment that they pivoted to because the unemployment level rose from 410 to start the year to 4.6 to end the year. And that, again, forced the Fed's hand into cutting rates multiple times. So we got that one right. And then earnings and buybacks, we just said, look, will be another source of strength. Earnings were looking like they would reach all-time highs. They did in 2025. Buybacks, the same. They did. So, kind of a clean sweep,
Yeah.
which, we're very hopeful for now with our new outlook. But we'll get to that after we go through some of the finer details of 25. We'll spend a few minutes going through these details.
Yeah, no, kudos to you, the investment committee. It's a great example of our independence and the fact that the research is quite telling and looking through the noise. And so let's take a look first at last year's headlines because I think I always joke this is kind of the wall of worry. It shows a lot of the anxiety of what individuals are concerned about.
Yeah, what people were thinking about, what they were searching for. And, this chart is so big, we cut it in two, but it's really a chronological order. January on the left to the December on the right. And you can see we started the year with the unfortunate Palisades, California fires. Halfway through the year, you saw things like tariffs and Labubus. And on the right hand side, we morphed into things like Sydney Sweeney and Taco and this silly phenomenon called 6-7. You started to hear things like AI bubble and then the unfortunate Brown University shooting. So these are search results, and it's sort of a heat map to show you how the year progressed and some of the top topics, let's call it.
Mhm.
So a lot always goes on.
I heard 6-7 the whole holiday season. I thought it was done, and yet you had to bring it up. But here we
Yeah,
go.
yeah.
So
Hopefully we never hear it again.
exactly. All right, moving on. Let's talk about the asset classes from last year.
Yeah, really good outcomes for investors, regardless, generally speaking, of the asset class that you were invested in. You can see here that the S&P 500, which we always refer to as the market here in the United States, was up about 16% for the year. Very good return. The Dow Jones, which is only a basket of 30 stocks versus the S&P 500 that has 500, did well, but not as well as the S&P. So the Dow was up about 13. NASDAQ was up approximately 21%. A lot of that coming from technology. Mid caps were up about 11. Small caps up 12. The international index woke up about 32. We'll get into that.
Yeah.
That was primarily due to the currency move and not earnings. Very interesting. I think that's a once in blue moon occurrence that we had with international stocks. Bonds did well.
Yeah.
The aggregate bond index was up about 7%. Most of that came from yield, some came from price. But you also see things like cash, as represented by the 3-month T bill, was one of the worst performers. It usually is the worst performer. It was up about 4%. The spot price of oil declined 21%. Gold went up a shocking 63%, which I believe was heavily manipulated higher. I don't know that the fundamentals for gold are really there. You'll hear about this in future presentations. And then Bitcoin for 3/4 of the year was doing very well. It cooled off towards the end of the year and now has so far this year picked up some momentum, ended the year down about 5%. So
What a great example of the volatility that asset class can be.
absolutely.
And just to kind of take one step further with the stock market, I love looking at it long term. It's one of my favorite slides going back to the 80s and showing the resilience that it had this year. But candidly, the stock market ends positive 75% of the time, but it always has that volatility.
Yeah, it shows you the red dots, where it goes during the year.
Hmm.
And when it turns gray, that's where it ended for the year.
Hmm.
So there's always a wide spread between where it went and where it ended. And it always ends at a higher level than where it went,
Hmm.
right? It never closes at its low.
Yeah.
So what you see here, if you go all the way to the right, is you see the plus 16 gray bar and you see the minus 19, which is where it went, again, measured on a closing basis
Hmm.
during the year. And that low was on April 8th. The actual intraday low was the day prior on the 7th, which is when we invested in the market. Intraday, it actually reached about down 21%, but it didn't close there.
Yeah.
The low close was on April 8th, down 19.
Hmm.
So, the spread of, over 30%, right? 30% swing in return. But that's normal. That's what
Yes.
happens. Look at every other year
Yeah.
going back to 1980. That's exactly what happens. It's
Yeah.
a very widespread. We expect more of that in the coming year, maybe not a decline by as much, and maybe not an increase to as much, but somewhere close.
Well, and if I could reference the Dickens quote from earlier, a lot of these red dots, when you look back and you look at the attribution of the drawdown, they are more emotional than fundamental.
Oh, absolutely.
Yeah. So
Yeah.
the next slide was a real eye opener for me because we've been talking about the Mag 7 and the driver of returns for the last few years. Yet when you look at the top performers of the S&P 500 last year, they weren't there.
What a shocker. Yeah, I mean, the Mag 7 get all the attention because of their weight and their large ownership.
Mhm.
They're owned by many, but rarely are they the top performers of the S&P 500. I'll give you a hint that usually the top performers of the index the next year are the companies that were left for dead the year prior.
Mhm.
And if you look at this list, most of them fall into that space. Not all, but most. But SanDisk, Western Digital, and Seagate, who collectively make these memory cards that go into like cameras and small devices, right? So they got a boost from AI because storage for memory and stuff is needed.
Mhm.
Robinhood, which is a lower end trading platform, made a big comeback. But again, what you don't understand is they were down so much.
Yes.
Micron, again, one of the forgotten about semiconductor companies. Palantir, which is actually a very strong company. AppLovin, a trading vehicle for a lot of the youth.
Mhm.
CVS, which many thought was done for good, woke up a little bit.
Yeah.
GE Aerospace, strong company. Intel, and that performance was heavily infused by the lifeline that the government gave it. So those
Right.
are your top performers of the S&P 500. None of them are Mag 7.
And Bob, we discussed this in our meeting. The top three, SanDisk, Western Digital, and Seagate, where were they most heavily traded?
Oh, in South Korea.
South Korea.
Yeah. Yeah,
Interesting.
there's a lot of investing in trade manipulation and speculation that goes on in the South Korea index. So you're right, Julina. That's a very good point. A lot of that return came from foreign investors, very specifically South Korean investors who
Yeah.
use these as trading vehicles.
So if the Mag 7 weren't the top performers, we have to take a look at, what their contribution was. And I think this is a great visual. It's not, as we just talked about it, it's not what it has been in the past, but they are still contributing to the S&P performance.
Yeah, this is a good visual to say, look, they're still doing a great job. However, there's more depth in the market than the media is, you know, talking about.
Perceiving
And
it to be, yeah.
yeah, what you see here, I mean, just since 2023. So 2023, the green bar is the return attributable to the Mag 7,
Hmm.
and yellow is the rest of the market. And what you see is the declining share of the performance contribution of the Mag 7 because the rest of the market is also waking up. And
Yeah.
the numbers game, there's 493 other companies versus the seven,
Yes.
right? So good time to be diversified, good time to own maybe a couple of hundred securities within the market. Again, maybe not individually, but there is depth and breadth to this market, and that's a very good sign of health for the stock market.
Yeah. And I think that's a great segue to, I think the other surprise is the volatility isn't as expected. We certainly had some spikes, particularly in April, but
Yeah, yeah.
from start to finish,
We just show you this because we're telling you from point to point, from January 1st of last year to December 31st of 2025. I don't think anyone would have guessed that volatility would decline,
right.
but it did. I mean,
Hmm.
during the year, you have your spikes, especially the big one that you see here is tariffs. That was the tariff week rollout.
Hmm.
The volatility index spiked quite a bit. I should also tell you, whenever it spikes above 30, you buy the market,
Hmm.
which we did,
Correct.
because it rarely goes above 30, right?
That's a
Those
hard thing to do when you're
those
emotional.
those are the dips you want to buy.
Yeah.
And for some reason, if it ever goes past a level of 50, you really want to buy those dips.
Correct.
So,
Yeah.
but yeah, the volatility index from point to point declined. How
That was a
about
surprise.
yeah?
Yeah. Okay. And you addressed international in the beginning and the outperformance, and you alluded to the currency. So let's talk about that.
Yeah. So when you look at the attribution of total return for various stocks or indexes, right? What makes up the total return? Well, you typically have dividends that
Hmm.
make up a certain percentage of return. So let's say if a stock market has a 2% dividend, well, that'll be a positive 2% return, right?
Hmm.
So throw that in the bucket. Okay. What else can we put in there? Well, does a company earn money? Does the index in aggregate have positive earnings? So, okay, we have earnings, we have dividend. What else could there be? Well, foreign stocks, non-US stocks, you'll have a currency contribution. Did it add to the return or detract from the return? And then you also have something called PE contribution or multiple expansion. Were investors willing to pay for next year's earnings? Meaning, are you willing to pay a premium for that stock based
Hmm.
on their forecast for next year and the year after and the year after?
Yeah.
And what you see sort of in the middle of this chart is, the broader indices, the stock 600 and the FTSE 100, big global indices. The breakdown of return was really driven by currency, right, which was heavily influenced by trade risk,
Right.
and the willingness to pay up for future earnings.
Yeah.
None of this came from fundamentals,
Correct.
right? There was a small amount of dividends. There's always a small amount of dividends. And there was a smaller amount of earnings in these indices.
Yeah.
So it's not like there was a big fundamental shift. No, it was heavily influenced by currency and heavily influenced by, hey, maybe the stocks got to a point where they were so cheap overseas that some people said, well, let's hold our nose and buy some.
Correct.
And that's what happened. And to be honest with you, most of that return uh, came in the first 5 months of the year. Again, all due to trade risk.
To the trade risk. Yeah.
Yeah. And
And
then it kind of went sideways for the rest of the year.
exactly. And I think it's also important to note that this is a reversal of what we've seen almost for the last decade as a summary. The international markets have been challenging because of the dollar strength.
One, number two, also because there's typically weak earnings overseas.
And that too. Yep.
Yeah.
Okay. Thank you. And so, we addressed the bond market as well. They had a good year last year. They kind of haven't really received any reward for that, but we wanted to point out not only that, but the consistency of bonds over the longer term, right? And why they're such a stable anchor in a portfolio.
Yeah. So in a stock bull market, right, where I believe we're actually in a bull market 80% of the time. But in the midst of a bull market, you forget about bonds as an asset class. And usually when that happens, they actually give you pretty good returns. And what we saw last year was the aggregate bond index, which is the big index, returned about 7%, which is great. Not too
Yes.
shabby at all. More than half of that came from yield,
Hmm.
and you had a little bit come from price. And the price appreciation came from the 10-year treasury declining. That's how it works.
And we've
Uh,
been talking about this for quite some time.
quite some time.
Yeah,
Again, it's a boring topic, but this one is much easier to project because it is rooted in math.
right.
So
Perfect.
more to come on that. We think this upcoming year will be a pretty good year for bonds as well.
Okay, great. And let's talk about the key lending rates.
We put this in here because this is very important. We reached peak unaffordability in 2024, and that was a combination of incredibly high inflation rates. Near the peak, I believe the peak was in 2023. Started to cool a little bit in 2024, but you also continued to have price appreciation in autos and in homes. So the combination, how they come up with the unaffordability calculation is they use finance cost and they apply it to the new price of major assets,
Mhm.
right? So how much does it cost to buy a house if you finance it? A lot more than if you pay cash, because when you finance a home for 30 years at, you go back 2 years at 8.5%,
Mhm.
you're paying 4 times as much for any home,
Yeah.
5 times as much for any home over time. So we reached the level of peak unaffordability, and towards the end of 2024 and then all throughout 2025, the unaffordability level is starting to plummet, and part of that is prices nationwide have been relatively unchanged. Actually, when it comes to housing, most of the country saw price decreases.
Yeah.
um, Number one. Number two, 30-year fixed rate mortgages have declined by about 10%, right? The interest rate has declined, and we believe will continue to decline. And the same has been happening for car loans. So as unaffordability declines, affordability, right? The other side of that rises, which is going to spark more economic activity, which I'm sure we will see play out through 2026.
Great.
Yeah.
And as we kind of complete this part of the presentation with the 2025 in review, we wanted to be detailed because it is going to set the backdrop for this upcoming year. So we're going to
Yeah.
transition now to our outlook and the setup. And as we did last year, we started with this slide, which was Wall Street's target for this year. And I
Yeah.
think, and I know you want to talk about this.
Yeah, if you were to chart this over a long period of time, you'll see that the average target is almost the low end of what actually happens. So last year, I believe the average was everyone calling for a continued bull market, but the S&P getting to about 6,200. It ended the year at almost 6,900. Our outlook, we were close to 7,000, which we were very close to. Again, our outlook is, greater than 10% up from here. So we'd be in the, let's call it 7,800 S&P camp. You can see the average is about plus 10 at about S&P 7,500. But one thing to note, everyone on this list for the first time in a while is expecting a positive outcome,
Mm,
from slightly positive to very positive. That's
yeah,
the spread.
yeah,
So you typically don't see that. You always have a couple of negative outliers. This year we don't,
interesting.
especially on this list. So this is really a list of all the large investment banks in this country and their outlook for the S&P 500 in the coming year.
And isn't it so funny that the average target is 10%?
10%, yeah. It typically hovers somewhere around 8 to 10% for the stock market. Yeah,
Amazing.
yeah,
Okay. Well, and let's talk about the state of the consumer. We look pretty good.
yeah. So for our outlook, you have to look at the state of the consumer, because without consumption, you don't have any economic activity. Without economic activity, you shouldn't expect a bunch of earnings growth. And without earnings growth, you shouldn't expect any market growth, right?
Yeah.
So it all comes back to some of the fundamentals, one being the consumer and the state of the consumer, and things look fantastic. On
Hmm.
the left side, you have the consumer balance sheet in this country, and there are just shy of $200 trillion of assets held by consumers right now, and there is just shy of 21 trillion of liabilities. The debt to asset ratio is quite wide. There's a lot of equity in many things, homes, securities, just about anything, any asset. So the setup is very good. On the right side, when you look at debt service ratio, so income as opposed to debt and expressed as a ratio, the debt to income ratio is still very low. The long term average hovers somewhere around 13 to 14%. And right now, as of the fourth quarter of this past year, we're around 11.6%. You see, it was lower around COVID, but remember that was because payments were postponed for many notes.
Mm-hmm.
There was an infusion of cash from the government to
Yes.
every person in business, and a lot of that went to pay down debt. So that was an abnormally low level. I
Mm-hmm.
would say we're now at a real low level.
Yeah.
So
Outside of the pandemic, it's the lowest.
yeah, absolutely. And then, something that's talked about all the time is delinquency rates. What you see here is auto loans and credit cards and mortgages. Yes, they're up from the COVID low, but remember, there was a moratorium on making payments. So that was an artificial low. So whenever you compare a current level to an artificial low that maybe shouldn't have been there, there's always going to be an increase. The thing that did increase is student loans. And part of that was everyone thought their student loan was going to be forgiven. So everyone thought that their education in this country was going to be free and their neighbors would pay for it. Come to find out, that's actually illegal
Yeah.
to do. And it looks like a lot of these kids, for years were thinking that their debt was going to be forgiven. Now it's a wake up call. Hey, it's time to pay your bills. I bet half of the kids who are delinquent don't even know that they have to start paying their loans again. So I don't think that's really a big deal, although the media loves to talk about it.
Of course.
So,
Yeah. So the consumer looks great. Let's also talk about corporations.
yeah, the setup in the capital markets looks great as well.
Mhm.
So earnings, we have new highs in earnings with expectations for earnings to continue to rise, but the entire market is setting that expectation. So not only the big companies, it's the big companies, the mid-sized companies, and the small companies.
Right.
Number two, there's lots of cash on the sidelines still a
Yielding
massive
four.
amount. Yeah. Three, buybacks are at all-time highs and rising. So buyback estimates continue to rise. These are very good things. And dividends, when companies have a lot of cash and they have a lot of earnings, they get to replenish any cash that they spend with more earnings. They tend to also increase dividends. So all of these are actually moving in the right direction.
Yeah. And
A very
these are
good setup.
all themes that we talked about last year in regards to the fundamentals of the market, and it hasn't changed. So we remain optimistic there.
We have it again this year.
Yep. And let's talk about the rest of the world in regards to earnings, because we have been the driver of that.
Yeah. So, for the United States, we've had, 3 good years of earnings growth. We believe that will continue. And apparently, so do the analysts that analyze the markets and companies. And so do the CEOs and CFOs that run these companies.
Mhm.
Their expectations, which are usually very conservative, are that earnings growth will grow by approximately 14% in the coming year, which is
Mhm.
amazing. Historically, the market has about 8% earnings growth. So anything above that is surprisingly good. Europe, Japan, emerging markets, and even China are expected to also grow earnings quite a bit. Um, Again, if you measure over the past 3 to 5 years from a much lower point to something, but at least it's something. But again, when you have the entire world sort of setting the expectation that there's going to be earnings growth, there's probably a lot of good economic activity behind that, which is good for consumers and businesses and capital markets.
Yeah, absolutely. The next slide I really like because we do get this question a lot, which is fair, is the market expensive?
Yeah.
Where do we go
So
from here?
So we have a couple of slides on this, but that we'll get to. But this one is cute because what you see here is 2025 in a nutshell. You have the PE ratio of the S&P 500, the blue line, and then you have the yellow line or orange line being earnings, right? And you always typically see that in a growing market, in a growing economy, you will always see a market or a PE ratio that exceeds earnings, right?
Yeah.
Because the prospects for future earnings are something you want to invest in today, right?
Yes.
Because they're sort of discounted today and you
Be
can realize
rewarded.
them in the future. And that's where you get an increase in value. Well, it's better, rare, but better when you actually get earnings that exceed price increases.
Mm-hmm.
It's amazing. And what you saw towards the end of 2025, the fourth quarter, is earnings and earnings estimates far exceeded price. So we have a scenario where earnings and estimates are rising faster than price returns.
Correct.
Shocking. That usually means that you have a runway for higher prices,
Correct.
right?
Yeah.
So the PE ratio last year on the market was barely changed. It hovered around that level all year,
Yeah.
right around 21 to 22, but the market went up
Mm-hmm.
on top of earnings, supporting it by going up even more.
More.
How
Yeah.
about that?
Yep.
Yeah, that's a very good scenario.
It's a great scenario. And one last piece here is profit margins also remain very high.
Yeah, on top of earnings, the profit margins that companies have, there's a lot of fluff, there's a lot of excess there, and when you have very high profit margins, you have a tremendous amount of cushion for protecting earnings growth,
Yes.
if that makes sense.
Mm-hmm.
So, the PE ratio is one indicator, one of probably 30 that should be used to paint the picture of valuations.
Yeah.
Another, which we believe is as important, is the level of profit margins, and profit margins are quite high.
Correct.
Yeah.
And hopefully the listeners can get a sense of our optimism again for this year in regards to the markets. I think that there's always a reminder that it's not a guarantee of short-term performance.
Yeah. So when you're hearing things like, oh, the market, the PE is too high and it can't stay here and, something's going to happen.
Mhm.
Uh, well, here is evidence that the current PE or valuations and next year's return
Mhm.
are not only not correlated at all, they're almost negatively correlated. Actually, they are negatively correlated.
Right.
It it's
Because that
it
yellow
has
line, the yellow line is trying to attempt to find a correlation and it's not.
absolutely, yeah. So I wouldn't worry much on your worry list for 2026. I wouldn't put valuations there.
Yeah. And just to give everyone an idea, you've got the valuations on the vertical axis and you have the performance of the S&P on the horizontal 1 year following. We don't have it on this slide, but if you were to look out 5 years or 10 years instead of 1 year, that yellow line has a lot heavier of a correlation of those blue dots, if that's fair to
Yeah.
say.
Mhm.
Yep. And so let's talk about change, incremental change over time. And this is a really interesting slide talking about not just the Mag 7, but the top 10 stocks relative to the last 40 years
Yeah.
and what's been those drivers.
Yeah, you forget how much the market's changed in a 10-year period of time.
Hmm.
They changed quite a bit. So when you go back to 1985, top 10 companies of the S&P were IBM, Exxon, GE, GM, AT&T, Shell, Amoco, Royal Dutch, Kodak, and DuPont.
Hmm.
10 years later, it looked very different.
Right.
10 years later in '05, it looked wildly different.
Hmm.
10 years after that, in 2015, again, very different. And then in 2025, different once again.
Correct. Yeah.
So what are we saying here? Well, that means the next time we show you this chart, which will likely be 2035,
Yep.
a lot of these top 10 names will either be absorbed by one another, merged with other companies, or there will be new up and coming companies that will find their way into this list.
Hmm.
So, the Mag 7 will eventually turn into a different Mag 7, which will
Correct.
eventually turn into a different Mag 7.
Yep.
So,
I couldn't help but think of my grandfather because when he passed away, my mom inherited a ton of Exxon stock and it
sure.
was on this list for 40 years.
Yeah.
Yep. So let's talk about some of the drivers of total return for stocks in general, because
As
there's
we
some different
mentioned,
components.
yeah, as we mentioned when we were talking about foreign securities, and part of that bucket of total return was currency. This is the U.S. view. what makes up total return? What makes up total return is a combination of earnings, dividends, and the willingness to pay a premium or not for securities at the current level,
Correct.
right? Based on their expectation for earnings in the future. So it's actually called PE expansion. And on the far right hand side, you'll see that there's a lot of yellow, which is earnings growth that made up the return
Mm-hmm.
for 2025, followed by some dividends and a little bit of PE expansion. So you see there that there was only 2.5 points of PE expansion. And typically, if you look to the left, that is usually the big driver, the
Mm-hmm.
big driver, the willingness to pay up for future earnings, PE expansion, that
Correct.
drives security prices. Well, last year we didn't need any of it.
Nope. Not last year.
Um, I'm going to go out on a limb and say earnings this year and for the next couple of years will likely exceed what companies put out there for their
Mm-hmm.
expectations, and it will likely far exceed what analysts are forecasting. And I
Okay.
think the stock market really enjoys that because those end up being positive surprises, and positive surprises do wonders for the price of the market.
Exactly.
Yeah.
No, that's great. And another question that we get all the time is, aren't we due a recession?
So bull markets last longer than you think.
Mm-hmm.
And this is a chart, sort of an analog versus prior bull markets since 1970. And, where are we in this chart? Well, it's hard to see. So we put a circle around it. We are where that circle is.
That dark
So,
blue?
yeah, what it really shows you is we have uh, very likely a long runway left for this bull market.
Mm-hmm.
Long
Yeah.
way to go.
Yeah. And the only one ahead of us that was short term, that purple line, that was the pandemic.
That was a pandemic. That's right.
Yep. And another favorite slide of mine, looking at returns of the market going back to the 1920s and where they kind of fall in these buckets of, 0 to 10%, which is hard to read. That's that light green in the middle of the page, 10 to 20, 20 to 30, 30 plus is the far right, versus the performance that's negative on the left-hand side. You can see how skewed these returns are.
It's very out of balance in a very green way. If you view this, everyone worries about that bucket to the far left,
Hmm.
which happens so infrequently.
Yeah.
Twice in the 30s and once in '08. The '08 one was followed by the longest bull market ever in history. And nobody really pays attention to the average, which is the green side, which is what happens just about all the time,
Hmm.
right?
Yes. Yes.
So everyone lives the wall of worry, which is on the far left, where there are three occurrences since 1926. And because of that, they don't lean into the right side returns enough. So, it's good to show these illustrations to see how lopsided it is to invest in high quality securities and to hold them for a long period of time. It usually rewards you quite well.
Yeah. I
And
think,
for some reason, if it doesn't, just be patient. It's very likely that you'll be rewarded within a couple of years, far better than you think.
yeah. I think another message that I love from this slide is, we live in a world of averages. The media loves to talk about averages, and the stock market averaging, call it 10% going back historically. And when you look at all of these returns going back to 1926, there's only one year that returned 10%, and that was 1993. We do not live a calendar year in averages.
Right.
So
That's like saying the average temperature in Connecticut is throughout the year 60 degrees.
there you go.
Right. But it's very fun in July when it's 104 and in January where it's 2 degrees.
Love
Right.
that analogy.
There's a lot that happens around those averages.
Love that analogy.
Yeah.
So let's talk about the markets being at all-time highs. We're already getting this question. Aren't we at all-time highs? What should we be doing in the portfolios?
Yeah. Julian, I threw this one in here for you because I know you like talking about this.
Love it.
And
And
I
you
think
already stole my quote.
I did. Oh,
Yeah.
right. 80% of the time.
Yeah, but
Yeah.
that's okay. We can say it
So,
again.
so long story short, people fear all-time highs. This is just a chart where a lot of investors wouldn't think this would be the case. A lot of people think you run away from all-time highs. You don't. You actually lean into them because they're contagious. There's a lot of momentum that's created for many years when you start to have all-time highs.
Hmm.
Um, and what you can see here, the chart on the left is interesting. I love the technicals. I love the technical side of the markets. It takes all the emotion and all the data out, and it's just numbers
Yeah.
and trends. And what you see is most of the all-time highs, when we reach new levels, they end up becoming the new floor,
Hmm.
right, for the future. So when the market pulls back, it pulls back only to that prior all-time high. And then
Hmm.
you reach another one, and
Right.
then you can go higher and test back to that level.
And
So it's like climbing a mountain with pegs,
yes.
right? Once you put the new high peg in, that's your high mark. You can only fall back to this level.
And Bob, you
So
say that because of the traders, correct?
yeah, it's a technical thing,
Hmm.
but it does make perfect sense because there's support around certain levels.
Correct. Yep.
Mhm.
Okay, great. So let's talk about, we identified in our agenda four key drivers for this year. And let's start with the One Big Beautiful Bill Act.
Yeah, they're big ones, and through our lens, we put them in order of we believe their moat and their level of importance
Hmm.
and how much support they will provide for the markets and the economy. And the first one is the soon to be impact of one big beautiful bill, how it impacts individuals through tax cuts, how it impacts quietly tax refunds this year,
Hmm.
because mandated withholding changes were not done last year. It will all be realized as a tax refund for a lot of people this year, which they're not even expecting yet. The immediate depreciation of just about anything, including research and development, which is good for any company that spends money on business building activities, on top of drug companies spending money on research. Right. You can also say that research R&D is also AI spending. All of that
Yeah.
is an expense that's fully depreciated. So there's a lot of support for business and business activity and companies spending money, less so government spending money, but companies spending money,
Hmm.
providing a lot of incentives and activity here. So we think it's still not fully factored into what's very likely to be well above average economic growth that should roll out. That actually should start to show up last quarter.
Yeah.
There's a delay in the reporting. So we'll hear about fourth quarter economic growth very soon, and we'll very likely hear about first and second and third quarter economic growth in the coming quarters. We think it will be quite robust.
Yeah. I think one of our challenges when we put this presentation together is so these themes are kind of interwoven.
Yeah.
And I think you'll see that as you go through it. But let's also talk about who is benefiting, what individuals are benefiting from these tax cuts.
Yeah, so with the sort of the extension of the tax cuts and minor modification to it, what you see here is the income percentile group that will benefit. The top 0.01% will lose, but everyone else wins. And
Hmm.
that's a very good thing for the consumers of this country.
Yes,
Yeah.
absolutely. And let's take it one step further and talk about the refunds and stimulus and the length that this opportunity can go on for.
Yeah, the top left, you see here the year over year change in tax refunds. So from 24 to 25, there was a blip positive, but from 25 to 26, that's a pretty significant leap.
Hmm.
That I'm just going to call that a tax refund that is so big it'll provide fiscal stimulus. Right, this will provide on average a free vacation for people.
Hmm.
And when money arrives in the hands of most people unexpectedly,
Yeah,
that money is much more easily spent than when it's expected.
got it. And the expectation is that this could go on for another 7 years, in a diminishing way,
The
but
bottom right
still,
hand side, you're
yeah.
absolutely right. So the benefits of this bill are set to provide some pretty significant stimulative benefits,
Yes.
not for a year or two, but for potentially the next decade.
Okay, great.
Yeah, so it has a long tail of benefits to it.
Great. So the first is the One Big Beautiful Bill Act. Let's talk now about AI and power
Yeah.
and the
AI, we
connectivity.
believe, will continue to be another key driver of both the economy and the capital markets and headlines in the media. What you see here is this wonderful S curve by one of the research groups that we use, Ashmore. And what they show you is phase one, then a bottleneck, phase two, and then phase sorry, bottleneck phase one, phase two, bottleneck phase two. So this is where you have quick implementation, quick ramping up, hyperscalers buying and spending, which then turns into other sectors absorbing the benefits of it, right?
Hmm.
Which
Yeah.
then leads into another ramp up of innovation, which leads to a period of absorbing what has been created and how to use it, how to implement it, systems you have to use, infrastructure you need, so on and so forth. There's there's quite a bit of runway here for
Apparently.
AI in its S curve. So
Yeah.
so more to come, but you can kind of read for yourself where it's likely to go.
Yeah, and as they're suggesting that we're in the initial phases here, then you kind of take a look at, okay, where is this innovation relative to large past innovations like auto manufacturing in World War II and railroads, and
And
it's
oil and gas and telecommunication and all that stuff. So where is it? It's right where it should be. Um, Prior periods of innovation, right, have made significant contributions to the economy and capital market.
Mhm.
And what you see here is we're only about 2 years into the start of this cycle,
Yeah.
and we already have quite a bit of impact to the economy. Not as much as prior, because remember, going back 100 years, the U.S. economy relied much more heavily on one or two key things happening in the country, like developing railroads, right?
Yes.
Um, I think our everyone's roots in this country go back to someone having a relative that worked on a railroad somewhere, right? And in the 50s and 60s, I think everyone's roots led them back to everyone had a relative that worked for AT&T or Bell Labs or something like that.
Hmm.
And now you have a different scenario where people have roots in healthcare, people have roots going back to nowadays technology,
Yeah.
AI, all these different sectors. So we have this yet we have this a similar level of impact because of the robustness of AI, and we'll talk more about that very shortly.
Yeah, absolutely. And
Yeah.
another really interesting slide on this is the spending in 2025 as a percentage of the economy, right? Not in dollars, relative to past infrastructure projects. It is mind-boggling to see the
Mhm.
difference.
Yeah. So the spending on AI um, was almost the same as the 30s public works project, which was like LaGuardia, Golden Gate Bridge, Hoover Dam, Triborough Bridge, the Manhattan Project, all electricity back in the 40s and 50s, the Apollo project of the 60s, the Highway project of the 60s, and then broadband telecom capex of the 2000s. Glue them all together, and you have today's capex spending,
Mhm.
which is also very likely this year to exceed last year.
That's amazing.
Yeah, yeah. Just this really shows you how big it is.
Absolutely. And which is a great segue into the fact that it is ramping up.
It's ramping up, and I guess a lot of people wouldn't guess this, that there's a lot of adoption by just about all sectors.
Mhm.
On the left, this comes from JP Morgan, the adoption rate by sector, and what you see here is obviously IT and tech major adopters, but behind that is finance and insurance,
Mhm.
followed by educational services,
Amazing.
right? So there's efficiencies and process improvements to be had everywhere.
Yeah.
Then you have manufacturing, retail, healthcare, construction, and we believe that this will continue to grow quite a bit. Why?
Mhm.
Well, because on the right hand side, that's what they're telling us. So you have adoption rates going back to 24 in blue. Then you have the new level adoption rate in yellow or beige, and then you have the next 6 months expected adoption rate just keeps rising and rising and rising.
Yeah,
So
that red bar is just the next 6 months. It's amazing.
absolutely,
And it's ramping up because
because all of these sectors, generally speaking, are seeing cost efficiencies from the usage of better technology.
Mhm.
Number one, and many sectors are seeing revenue increases on top of the cost decreases.
Right.
Um, so, it's being used more and more by many more than you think because there are real benefits. You can
Right.
find a way to use it to your advantage.
Yep. Which is why companies are spending more money on AI.
which is why companies are spending more money. And this chart is consensus CapEx growth estimates for the AI hyperscalers, the big spenders of AI.
Hmm.
You have the market saying that uh, uh, CapEx growth or spending growth will be about 19% going back to 2024. And what was realized was 54%.
Yeah.
So then they said, hey, wait, we got that wrong. So 2025, they changed their estimates to up 22%, and there was 64% spending growth.
Yeah.
And shockingly, in 2026, they're saying, well, could they spend any more? We'll just flatten it out back to 19%. I'm going to go out on a limb and say that the light blue chart for 2026 will be higher than the 19 that's being forecasted because that is the trend.
Yeah.
Yeah.
So with all this performance around it, forecast around it, the question that we get a lot is, do I own AI? How do I own AI? And I think this is a really interesting slide.
Yeah, so here's the value chain of AI and some of the names that you know. The secondary beneficiaries are sort of the next level,
Hmm.
and companies that are quietly benefiting from and play a key role in the AI value chain. And then on the right side, other companies that are not only key contributors but key beneficiaries to what's going on as well. So again, you're now starting to see the breadth and depth of the positive impact of AI, at least in the business world, which is going to lead us to another opportunity here.
Well, exactly. We talked about AI so far, but where does power come into this?
Well, hopefully it comes into it quickly because we
Yeah.
need a lot of power. So
Yep.
when you look at data center usage in the top left, what's expected by 2030 is we're going to need a lot more power because there's going to be a lot more usage.
Hmm.
Um, and if we need power, then we need all forms of power. Number one. Number two, we need the infrastructure to bring us that power.
Yep.
And what you see here is investment need in infrastructure by region. And on
Yeah.
the right hand side, there's a huge need. On the left hand side, you see a lot of planned spending and a lot of spending that has to still happen.
Yeah.
So buckle up. It's going to be a pretty extensive uh, project for the world to ramp up its infrastructure in order to power everything that we need to power.
Exactly, which has led to more spending on infrastructure.
There is your ramping up, especially if you just look
Yep.
since 2010.
Yep.
That's a pretty significant increase.
Yep. Which then creates an opportunity within the infrastructure power theme.
On top of the fact that a lot of those names in the infrastructure space
Hmm.
uh, aren't expensive at all.
Yeah.
So we think that's going to be a key investment theme for our clients this year and
Great.
potentially for years to come.
Yep. So the second is AI and power. And let's now talk about the third one, which is the new Fed.
Another influencer is going to be the new Fed.
Is it more dovish?
The new Fed. The new Fed will likely be more dovish. This is a great scale of telling you who the voters are,
Hmm.
26, 27, and 28, ranking them as hawk. Hawk would be red, dove would be blue. And what you see, even Powell himself is a dove, but he will very likely be replaced, and we're going to hear about this soon, who the pick will be, by a bigger dove.
Yeah.
So I believe the Fed will continue to lean dovish and incrementally more dovish after the renovation that's going on at the Fed.
Got it. In discussion with the Fed, we've been talking about inflation for years. And then finally last year, we introduced employment. And so let's talk about employment going into this year.
Yeah, you can see here that it was really employment that forced the Fed's hand, and I believe that will continue to be the case because inflation will keep rolling at worst sideways, but very likely lower.
Yep.
When you measure live, it's sub 2%. And again, when you measure live, it pulls out all the lags from
Hmm.
all the data.
Yes.
And if you were to track live inflation to the direction of the lagging inflation, it certainly leads it lower.
Which is interesting because it was one of the top searches throughout the entire year last year, despite it was all about employment. But what will take us lower here?
Yeah. So when you look at the components of inflation, the reason why I don't think the Fed is worried as much is because the big chunk that is rolling lower, but it's still a significant piece of inflation is shelter. Shelter has an 18-month lag. You've heard us talk about this, but
Yep.
you can see that dark blue line where it peaked in 23 has been rolling lower and lower and lower consistently.
Hmm.
And then we had a big surprise even lower in the most recent read last month. So we think the shelter component, number one, because it will continue to roll lower, number two, because of its weight in the inflation calculation, will
Right.
take the entire complex lower with it.
Yeah. And I think a lot of individuals struggle with inflation and understanding that it really has come lower, which is why I love this slide as well.
Very interesting chart here. What you see when you look hover above 2022 and 2023 is most of the components of inflation were rising annually by greater than 4 to 5%. That's why it dipped to dark red.
Those are the red.
Um,
Yeah.
since then, now the largest share of the components have been rising by 1% or less, which is the dark blue.
Hmm.
And anything rising by 5% or more, it hasn't vanished, but it has diminished down to a small level, which is the dark red up top.
That's great. Yep.
Yep.
And one last point on the Fed in talking about affordability.
Yeah. So we've been talking about the government is going to do something to assist or influence mortgage rates.
Hmm.
Again, if you want the unaffordability level to come down and you want to make things affordable again, it really comes through finance cost. And the Fed controls short-term rates, which provides some influence to long-term rates.
Hmm.
You need some type of intervention, some type of plan, some type of direct stimulus to help bring mortgage rates down. We believe we'll hear more about this in the coming months. There'll be some type of program or technique used to bring mortgage rates down. We're quite confident in this one.
That's
And
great.
what you see here is the spread of effective rates where people were able to refinance and get a mortgage at 2 or 3%
Hmm.
versus maybe people that didn't, who are paying today's average fixed rate, better than it was 2 years ago, but it's still relatively high compared to where they've rates have been over the past 10 years or so.
Right. All right. So let's transition into the last theme, which is government influence. And we're going to start with tariffs because
Yeah.
there is an imminent decision from the Supreme Court.
Yeah. So we're patiently waiting for the Supreme Court to weigh in on, their view on tariffs, keeping in mind this only applies to IEPA tariffs, which is about 55% of the tariffs. The other levels of tariffs have been codified. So it's really IEPA. So it's really half tariffs. But what we have seen, if you really paid attention, is, since the implementation in April of last year, there have been very selective, very strategic modifications for companies and sectors and key parts of the economy. So when you take the level of tariffs and how many are being applied and you chart them throughout the
Hmm.
year, they continue to decrease. So it's almost like the nicer you are to the United States, and the more we need a certain product, service, material, um, tariffs magically find a way to either disappear or go lower.
Mitigate. Yeah.
Yeah, so that is the trend. And again, I just come back to the fact that this is just uh, a major piece of negotiating leverage
Hmm.
for the United States and the president, who really intended it on using it that way for as long as he possibly could.
Right.
What do we think will happen with the Supreme Court? Um, we think that they may view the tariff situation, at least IEPA tariffs, as not constitutional or unconstitutional. Because I'm yet to read the Constitution and see where tariffs come in,
Mhm.
because that is really a job that runs through Congress. However, there's probably some level of embargo like activities that will be allowed.
Okay.
So does stuff get reclassified? Does it get reapplied in a different way? Does it get challenged? Who knows? Um, but all in all, when you net it out, it's very likely that the tariff rate, who it applies to and what it applies to, will likely head lower, probably not higher,
Okay.
if that
Yep.
makes sense.
Absolutely.
Yeah.
Yeah. And there's also, you talk about trade policy. There's been a lot of uncertainty that clearly has become more certain.
Well, ultimately, as time passes with new things and there's clarity and rulings and
Hmm.
decisions and modifications and articulation, there's more certainty and less uncertainty.
Hmm.
And guess what markets love? More certainty,
A lot.
right? They
Yes.
really don't like uncertainty.
Hmm.
Um, so as time passes here, which should continue, we will certainly have more economic certainty,
Yeah.
and that's a very good thing for capital markets, not only here but everywhere.
Yep. Uh, my favorite title slide of this month is the tariffs, the new income source.
Yeah. So why we don't think they'll go away completely
Right.
is because, well, shocker, the government is making a ton of money off of them, and whether you're a Republican or a Democrat, you love money. And again, whether you're Republican or Democrat, you love to spend it.
Yeah.
So good luck not having that income to spend.
Right.
So, and once it comes in for an extended amount of time, you don't want to give it away.
Exactly.
Yeah. So, a case for why you won't see tariffs disappear completely,
Hmm.
but you may see them reduce slightly.
Yeah. And a great example of sort of weaving in these themes is let's talk about resource security and some of these key materials.
Yeah, under the government influence section, one thing we heard more about is who has all these raw materials, specifically the rare earth minerals.
Hmm.
Who has them? Not us.
There's a lot
Everyone
of
else.
purple.
There's a lot of not us on this chart,
Yeah.
and whether it be things like lithium and cobalt, chromium, nickel, zinc,
Hmm.
silicon, graphite, rare earths, they're not here.
Right.
They're elsewhere.
Exactly.
Yeah.
And let's talk a little bit about these rare earth materials in relation to China.
Shown another way, uh, China's rare earth market share, when it comes to magnet production, rare earth refining, and mining,
Hmm.
they dominate.
Yeah. Yep.
Um, when you look at the U.S. China trade import export numbers, you can see that the U.S. really relied very heavily on China up until 16, 17. Then you had some. Uh, then you had the first version of tariffs and trade changes come in 18 or so. Then Biden got in and sort of kept what Trump put in place in his first term, which is why you saw our reliance on China decline. And, through 2024, we don't have the 2025 numbers yet, but you can see that we're diversifying away our
Hmm.
reliance on China pretty quickly. Now, the scale of this shows us from 20% of China's exports in 18 all the way down to about 13% in 2024. And I'm going to guess probably 10% in 2025. Um, that's very likely a better balance.
Yeah.
You don't want to rely on one main supplier for everything.
Right.
Um,
And
so,
and I think
a lot of this was rebalanced through the trade deal efforts.
yes. And in doing this, excuse me, I for interrupting this has created this exporting deflation, selling more for less theme.
Yeah, because China isn't slowing down creating stuff because, they create stuff and they sell it and they get the cash from that, right?
Hmm.
So it's utilizing inexpensive labor in maybe inferior materials to create goods that people consume here and everywhere else. Uh, China isn't slowing down the manufacturing of anything. They're
Hmm.
just finding other countries and other people and other businesses to buy their stuff. And they usually find a buyer because they are very willing to decrease price in order to move product.
Okay.
That's really what they care about.
Yep.
And again, we wrote a paper on this, I believe, a year ago, maybe 2 years ago. that don't worry about inflation. China will continue to deflate the world,
Yeah.
right?
Yes.
And here you see it.
And here you see it.
Yeah.
Exactly. Yeah. And let's talk about deregulation a little bit here as we see these IPOs picking up.
Yeah, another form of government influence is coming through deregulation, and you know, a good sign of it is initial public offerings, mergers and acquisitions, and IPOs, companies going public. We started to see a ramp up in 2025 from low levels in 22 and 23. 24, you had a bit of a boost, a little bit of optimism in a bull market.
Mhm.
2025 really just due to good momentum, lower rates, and an easier path to IPOing.
Great. And kind of sticking with this theme, let's talk about private equity.
Yeah, so you back up the IPO theme with the need for private equity to take a lot of the companies that they have in their portfolios public because they need to
Mhm.
monetize them.
Yeah.
So we expect a massive amount of IPOs to come out of the, um, should I say, bowels of private equity companies. Yeah, that's where it's coming from. So, how about this, Julina? Private equity needs public money.
Amazing.
And to get that, they are going to soak up some of the bread, which
Mhm.
is cash, with new, fresh, publicly traded companies for investors to deploy their capital into.
How the pendulum keeps swinging.
How
And
about that?
yeah, and how about M&A action?
As we talked about, mergers and acquisitions through a lighter regulatory regime usually pick up. And well, that's exactly what we're seeing. So, again, IPOs and mergers and acquisitions really, that's economic activity, capital markets activity, which
Yeah,
again is a very healthy, good sign for the markets.
great. Last point, we can't end this without talking about the midterm election.
Oh, we have one of those, huh? So, yes. So, just a reminder, it's an even number year. An even number year leads us to a House election. And when you have a House election, you have every seat in the House up for grabs. They are
Mm.
2 year term seats. And on top of that, you have 33 seats up for grabs in the Senate. If you ask us, we will probably end up seeing divided government. How it will be divided, again, and nobody knows, but our guess is the House will likely barely turn blue and the Senate will remain red. And you have a Republican president in the White House. So you will very likely have divided government by the end of the year. What does the market think about that? Well, generally speaking, the market performs best when you have divided government. And it also performs very well when you have a second term president during a midterm election year. So there's a whole bunch of stats that we can show you. We don't want to bore you anymore, but that will be under the term of government influence, things that will
Mhm.
influence the capital markets this year. This is certainly going to be one of them towards the
Yeah,
end of
I would say this topic, along with all the other themes, we are going to continue to discuss throughout the year. But we can't end without one of our, we'll call it market principles slide, and talking about measuring less so that we can remain more happy. If you want to explain it.
Yeah, this is if you observe the daily return of the S&P 500 over the past 3 years, your your view would highlight a bunch of peaks and troughs, a very
Like
bumpy ride, but higher.
like opening your app every day and looking at your account.
Absolutely.
Mhm.
It's up and down, up and down, up and down. Some people look every minute, but up and down, up and down, up and down. That's what are you measuring? So
Mhm.
when you look daily, it's a bumpy ride.
Right.
When you look weekly, it's less bumpy. Direction's the same and returns the same.
Hmm.
When you look monthly, it
Yeah.
takes a lot of those bumps out.
Yes.
So if you just look statement from statement, I can even argue quarter to quarter
Yes.
shows almost no bumps.
Right.
Um, the outcome is going to be the same. Don't drive yourself crazy by checking too often. Try to find something else to do with your life and your time. Spend it with family or reading a book or playing some sport,
Hmm.
cards or something like that. So, what I should also say is, yes, this will certainly make you smile more and make you worry less. But there's a bunch of stuff that we didn't cover. There's a lot of stuff going on, and we'll probably get questions of why we didn't cover the Venezuela thing. It's because we will very likely in the coming month or two, and
Sure.
why we think that happened and the strategy behind it. It might have to do with things like Russia and uh, China and Iran.
Right.
I can almost guarantee it does, and we'll show you that in charts. Why didn't we talk about metals? Well, it's, through the infrastructure lens, we kind of did. Why didn't we talk about gold? We will, but not right now. Really, we're trying to get our hands around the manipulation that happened to gold and silver.
Hmm.
I would be very cautious thinking that gold and silver are going to rise exponentially from here. Gold is not an industrial metal. It has very minimal use value. It's really used as a currency hedge.
Hmm.
But what happens when currencies have already been hedged?
Right.
Now what? Um, so again, a lot of stuff we didn't cover. A lot of stuff. Don't
Yeah.
worry, we're thinking about everything, and we'll cover in the coming months and quarters. But the outlook is very strong for this year. Again, starting with the economy,
Yes.
a fundamental capital market setup that's wonderful, mixed with a strong economy, mixed with some other themes
Hmm.
that should lead to a good year and potentially more good years to come.
Yeah. We have 150 slides and we didn't throw the ones that we didn't use out. We're good to go for this year.
Yeah, for this presentation, we created enough data for the next 15 years. Don't
I
you worry.
think so. Yeah,
Yeah.
but I really hope that the listeners again get out of this the continued optimism for this year. Don't be surprised if short-term emotional volatility, right? It's the same principles that we like to remind everyone of. And as always, we are here if you have questions. We encourage your questions. We encourage your feedback. And so please let us know. We're here for you, and we look forward to updating you again in February.
Yeah, and
Thank you, Bob.
we look forward to delivering some good news pretty frequently to our clients.
Yeah. Thanks, Bob.
See you soon.